Okay, so let's talk about the new IFRS S2 climate standards. If you're in the financial sector, there's one term that has probably jumped to the top of every meeting agenda: financed emissions. And listen, this isn't just another metric or a new box to check. It's a fundamental shift in how your institution is going to report on and be judged for its climate risk. So let's break down exactly what you need to know and what you actually need to do to get compliant.
So, here's our game plan. We're going to start with the mandate itself. What are we even talking about? Then, we'll clarify who's on the hook for reporting. From there, we'll get into the real nitty-gritty, the core metrics, how you actually calculate them, and, this is super important, how you disclose your methodology. Then we'll wrap it all up with a practical checklist you can use right away.
All right, first up, the mandate. Before we get into any of the math, we have to be absolutely crystal clear on the definition of financed emissions. And for something like this, you have to go straight to the source, because in the world of reporting, the official definition is everything.
Now, this isn't just some industry buzzword. This definition is pulled directly from the IFRS S2 standard. And what it's really saying is that the emissions of your clients get attributed back to you based on the capital you provide. It's that simple. Think of it as a direct, quantifiable line connecting your balance sheet to their carbon footprint. The standard officially places your financed emissions into Scope 3, specifically under Category 15, which is investments. Now, why does that matter? Well, it means the climate risk that's baked into your entire loan book and investment portfolio is no longer just a hypothetical. It's a mandatory disclosure item. You are now required to measure and report your exposure to your client's transition risks. So now that we know what financed emissions are, the next big question is, well, does this even apply to you? IFRS S2 gets very specific about which financial activities are actually in scope here. And here it is, plain and simple. The standard spells it out. If your institution is involved in asset management, commercial banking, or insurance, you're in. You are required to disclose financed emissions. If you're in one of these verticals, this reporting is your new reality. Okay, so if you're in scope, what exactly do you have to calculate and report on? The standard boils it down to two fundamental and very much interconnected metrics. Think of it as two sides of the same coin. On one side, you have to report your absolute gross financed emissions. That's the actual carbon footprint number, right? Measured in tons of CO2 equivalent. Then on the other side, you have to report your gross exposure. That's the financial value, the total amount of money at stake. You have to report both, because one without the other just doesn't paint the full picture for investors and regulators. This brings us to the more technical part. How do you actually calculate and present this data? I'll tell you right now, a single top-line number for your whole institution isn't going to fly. The standard demands a much more granular view. Yeah, so the key word here is disaggregation. You have to break down your financed emissions by both the industry your client is in, like energy or manufacturing, and by the asset class you're using, like project finance or corporate loans. This is all designed to reveal exactly where your climate risk is concentrated. And here's a quick look at what that might look like in the real world for a commercial bank. Your final report would need a table something like this, clearly laying out the emissions tied to each different segment of your portfolio. This is the level of detail everyone will be looking for. Now, let's drill down just a little bit more into that gross exposure metric, because there's a really key detail for commercial banks tucked away in the standard. It's not just about the money that's already out the door. You also have to account for undrawn loan commitments, but you have to disclose them separately. Let's walk through a super simple example. Say you've offered a $10 million line of credit. The client has drawn down $6 million so far. That $6 million is your funded gross exposure. But that other $4 million, the undrawn part, you can't just ignore it. It has to be disclosed separately because it represents a future potential exposure. So reporting the final numbers is just one part of the puzzle. IFRS S2 is equally concerned with how you got those numbers. When it comes to your methodology, let's just say transparency is completely non-negotiable. And the standard says it right here in black and white. You are explicitly required to disclose the methodology you used. This means explaining how you attributed a share of a client's emissions to your specific loan or investment. Did you use an equity-based approach, a revenue-based approach? You have to say so clearly. Look, disclosing your methodology isn't just about jumping through hoops. It's what gives your numbers credibility. It's what allows investors to actually compare you to your peers on a real apples-to-apples basis. And it shows you have a robust process for managing climate risk. Ultimately, it all comes down to building market trust in your data and your strategy.
All right, we have covered a lot of ground, so let's try to pull this all together into a straightforward checklist that you can take back to your team.
Okay, here are the 5 key steps. First, just confirm you're in scope. Second, get a solid handle on the 2 core metrics. Third, make sure your data systems can actually handle disaggregation by industry and asset class. Fourth, do not forget those undrawn commitments. And finally, document your methodology from day 1. Don't wait.
So we'll end on this thought. This isn't some problem for the future, it's a challenge for right now. The standards are set and the expectation for disclosure is clear. So the crucial question to take back to your team is this: are your data, your systems, and your people actually ready for this new era of climate reporting?